All right, buckle up. Welcome to the deep dive, where we unpack complex ideas and reveal those surprising insights that help you stay incredibly well informed. Today, we're plunging into the fascinating, sometimes, pretty nuanced world of how companies truly make their money.
That's right. Understanding revenue recognition isn't just something for the accountants in the back room. It's absolutely essential to truly seeing how a business thrives and, well, what its financial health really looks like beneath the surface numbers.
Our mission today is to give you that shortcut. We're tackling revenue recognition advanced topics, pulling out those, golden nuggets of insight from the material you've shared. We'll try to make it crystal clear and maybe even a little fun.
We've got a pretty comprehensive plan for this deep dive. We'll start by unpacking the fundamental rules, the bedrock principles that govern revenue. Then we'll delve into the tricky world of long-term contracts, think big construction projects, and how companies measure progress on those. From there, we'll navigate through various specialized scenarios, like figuring out if a company is truly selling something or just acting as an agent.
Ah, the principal versus agent thing.
Exactly. Or how companies handle things like customer returns and repurchase agreements. And finally, we'll peek behind the curtain a bit, look at how companies keep track of all this intricate data, ensuring operational integrity.
So if you've ever wondered when a sale truly becomes revenue, or maybe why a company's financial statements look the way they do sometimes, you are absolutely in the right place. Let's unpack this. All right.
Right.
The bedrock of business, understanding revenue recognition fundamentals. Okay, let's kick things off with the absolute basics then. When we talk about revenue recognition, what are we actually saying? It sounds foundational, sure, but I suspect there's more to it than just, money hitting the bank account.
You're right, it's precisely about that nuance. At its core, revenue recognition is about identifying the precise point in time when an entity fulfills a promise, a performance obligation to its customer. And it does that by transferring a good or a service. The revenue gets recognized at an amount that reflects what the entity expects to receive in exchange.
Expected consideration, right. Not necessarily what's been paid yet.
Exactly. This expected consideration is crucial because it's not just about cash changing hands immediately. It's really about when the earning process is complete,
Huh?
when the company has actually done its part of the deal.
Okay.
And that distinction, it's vital for accurate financial reporting. It directly impacts a company's reported profitability, it influences their tax obligations, and, maybe most importantly for investors, it shapes how the market perceives the company's performance and its value.
Yeah. So it's really about the underlying value exchange, the completion of the company's side of the bargain. That makes perfect sense. Now, who actually has to play by these rules? Is this just for the big public companies, the ones listed on stock exchanges, or does it apply more broadly?
Well, the scope is quite broad, actually. This standard applies to all entities. We're talking public companies, yes, but also private businesses and even not-for-profit organizations, provided they enter into contracts with customers to transfer goods, services, or non-financial assets.
So really almost everyone then.
Pretty much. Whether it's, a local bakery selling a cake, a major software company licensing its program, or maybe a charity providing services under a contract, these rules apply.
Hmm.
The specific details might vary, of course, depending on the business, but the underlying principles are universal.
That's insightful because it means almost every business you interact with is operating under these same or at least very similar accounting principles. But are there any exceptions? What kind of contracts, if any, fall outside this main standard? Or is it truly universal?
Good question. There are exceptions. Certain contract types have their own highly specialized accounting standards. For instance, leases, that's a whole different area. Insurance contracts, certain guarantees that aren't warranties, and complex financial instruments. Those are all governed by other very specific accounting rules.
Okay, specialized stuff.
Right. But for the vast majority of direct sales of goods and services, this core revenue recognition standard is the playbook. And this overview is important for you, the listener, because it sets the stage. It helps you understand the rules of the game for almost any business you might look at or invest in. It's really designed to prevent companies from, say, artificially inflating their earnings by recognizing revenue too early. It brings consistency.
Right, comparability makes sense. 2, the universal playbook, the 5-step approach to revenue recognition. All right, so we know what revenue recognition is basically and who it applies to. But how do companies actually do it day to day? Our sources point to a 5-step approach. That sounds like a clear blueprint, something practical.
It truly is a systematic framework. This five-step approach is the universal playbook that companies use to properly apply the revenue recognition standard. Doesn't matter the industry or size, really. It brings that consistency and clarity we were just talking about, which is paramount.
Okay, let's walk through it. What's the very first hurdle? Step one, is it just, signing a deal, getting ink on paper?
Step 1. Identify the contract with the customer. And it's actually more than just a signed piece of paper. For accounting purposes, a contract needs to meet specific criteria. It has to have commercial substance, meaning it actually changes the future cash flows of the company.
Okay, it has to matter financially.
Right. Both parties must have approved it and be committed to performing their obligations. And, critically, it has to be probable that the entity will actually collect the consideration they're due.
So if you sign a deal but think you might not get paid.
That it might not meet the criteria for a contract under this standard, at least not initially. You need that probability of collection. So, step 1 is really about establishing that solid foundation.
That makes sense. Ensures the deal is real before you even think about booking revenue. So what's next? After you verified the contract.
Step 2, identify the separate performance obligations in the contract. Okay, this is where it gets interesting. These are essentially the distinct promises within that contract to transfer goods or services to the customer. A single contract might have several of these.
Like bundled deals.
Exactly. Think of buying a new smartphone. The contract might include the phone itself, that's one obligation, a 2-year cellular service plan, that's another, and maybe an extended warranty on top of the standard one that could be a third. Each of those could be a distinct promise, a separate performance obligation.
So the company has to break down the deal into its core components. Okay, what's step 3?
Step 3, determine the transaction price. This is the total amount of consideration the entity expects to receive in exchange for transferring those promised goods or services. And it's not always a fixed number, right? It can involve what's called variable consideration.
Variable, like discounts or bonuses.
Precisely. Discounts, rebates, refunds, credits, performance bonuses, penalties, all those things that can make the final price uncertain. The company has to estimate this expected amount, considering all those potential variations.
Okay, so it's not just the sticker price, but what they realistically actually expect to keep at the end of the day. And then how do they connect that total expected price back to those separate promises, those performance obligations we identified in step 2?
That brings us directly to step 4. Allocate the transaction price to the separate performance obligations. This is absolutely critical when a contract has multiple obligations. You take the total transaction price from step 3 and you allocate it among all the identified performance obligations based on their relative standalone selling prices.
Standalone selling prices. So what each part would sell for if you bought it separately.
Exactly that. What the phone would cost on its own, what the service plan would cost on its own, what the extended warranty would cost on its own. You use the ratio of those prices to divide up the total transaction price. This ensures that revenue is recognized appropriately for each distinct part of the deal. It's about fairly distributing the total payment across all the promises.
Right, making sure each promise gets its fair share of the revenue pie, so to speak. And finally, the moment of truth, step 5.
Yes, step 5. Recognize revenue when or as the entity satisfies each performance obligation. This is the when the actual moment revenue gets booked on the income statement. And crucially, this can happen either at a point in time, think all at once, when control transfers, like handing over the keys to a car, or it can happen over time, think incrementally as the obligation is continually satisfied, like providing a monthly subscription service. We'll definitely delve deeper into that distinction, especially when we get to those long-term contracts.
Okay, so it's a very methodical step-by-step process. Identify the contract, identify the promises, figure out the price, allocate the price, and then recognize the revenue as the promises are kept. And you're saying this isn't just theory, it's a practical process that companies around the world use.
Precisely. It's the standardized approach designed to bring that consistency and clarity we talked about to how companies report their earnings, no matter what they sell or where they are. It allows you, the investor or analyst, to compare the financial performance of different companies with a much better common understanding. 3. Deep dive into long-term construction contracts. Building for the future.
All right, that 5-step framework feels really solid now. Let's take it and apply it to a specific and often pretty complex area. Long-term construction contracts. We're talking massive buildings, bridges, infrastructure projects, things that can take years and years to complete. How does revenue recognition work there? It seems different from just selling a widget.
It definitely is, and this is where things get particularly interesting, and where those Step 5 nuances, point in time versus overtime, really come into play. For long-term construction contracts, the standard provides two main methods for recognizing revenue, either overtime or at a point in time. And the choice between these two fundamentally changes how a company's financial health appears throughout the life of a big project. It significantly impacts reported profitability and how progress looks year by year. A. Recognizing revenue over time. The progress method.
Okay, overtime recognition. That sounds like recognizing revenue as the work actually gets done, which makes intuitive sense, right? You're building a skyscraper over 3 years, you're clearly earning something as it goes up. But what are the specific criteria? When is a company allowed to do this?
You're right, the intuition is generally correct. It's about aligning revenue with the progress being made. But there are strict criteria. For a company to recognize revenue over time on a contract, only one of the following two specific criteria needs to be met. First, the entity's performance creates or enhances an asset that the customer controls as it's created or enhanced.
Controls as it's created. Right. Like a custom home being built on the customer's land.
Exactly. As the builder works, the homeowner typically controls that work in progress sitting on their property. That's one possibility. The second criterion is a bit more complex. It requires two conditions together. The entity's performance does not create an asset with an alternative use to the entity. The entity has an enforceable right to receive payment for performance completed to date.
Okay, break that down. No alternative use.
It means the thing being built is so specialized or customized that the builder couldn't easily sell it to someone else if the original customer backed out. Think a highly specialized piece of machinery built to unique specs.
Got it. And the enforceable right to payment.
That means the contract ensures the builder can get paid for the work they've already done, even if the customer cancels mid-project. It protects the builder. So if either the customer controls criterion or the no alternative use PLS enforceable payment criterion is met, the company recognizes revenue over time.
That really clarifies the logic behind it. It's about either the customer owning it as it's built or the builder being locked in with no other options but getting paid for progress. Let's make it concrete. We have an example. Tanner Co. is building a specific unit in a multi-unit residential complex for a customer. The customer pays a non-refundable deposit and agrees to make progress payments. If the customer defaults, Tanner Co. has the right to all consideration if it completes the unit. And crucially, the contract prevents Tanner Co. from selling that specific unit to another customer. So, based on those criteria, what's the verdict for Tanner? Over time or point in time?
In this specific scenario, Tanner Co.'s performance obligation is satisfied over time. Let's see why. First, does the unit have an alternative future use to Tanner? No, because the contract terms explicitly prevent them from directing it to another customer.
Okay, so no alternative use is met.
Right. And does Tanner have an enforceable right to payment for performance completed to date? The terms state they have the right to all consideration if they complete it, implying a strong right connected to performance, even if full payment hinges on completion. Also, the fact that Tanner cannot redirect the unit strongly implies the customer controls the asset as it's created. Why else would Tanner be restricted? So, multiple signs point towards overtime. This really highlights how the specific terms of the contract are king here, not just the physical act of building. It's all about control and enforceable rights.
Okay, so Tanner Co. can recognize revenue over time in this case. How do they actually measure their progress then? You can't just eyeball a half-built building and say 50% done, can you?
No, you need a reliable method. Companies typically use either input methods or output methods. Output methods, like units produced or milestones achieved, are sometimes used, but input methods are very common, especially the cost-to-cost method.
Cost-to-cost, how does that work?
It measures progress based on the costs incurred to date relative to the total estimated costs for the entire project. So if you spent $1.5 million so far and you estimate the total project cost will be $3 million, you're considered 50% complete based on costs. This method is appropriate if the company expects the contract to be profitable overall and can reasonably estimate that profitability and reliably measure the costs incurred and costs remaining.
Okay, costs incurred divided by total estimated cost gives you a percentage. And then how do they translate that percentage into the actual revenue or, more importantly, the gross profit they can claim each year? Our sources walk through a multi-year example using this percentage of completion method. Let's use those numbers. Say a $4,000 contract price, initially estimated total cost of $3,000, so an expected total gross profit of $1,000. Year one costs are $1,500.
Okay, let's walk through the 4 steps for year 1. Step 1. Compute the total gross profit expected for the completed contract. That's simple. Contract price, $4,000 minus estimated total costs, $3,000, $1,000 expected gross profit.
Step 1, $1,000 profit expected.
Got it. Step 2,
Yes.
compute the percentage of completion using cost to cost. Total costs incurred to date, $1,500 divided by total estimated costs, $3,000.
50%.
50% complete. Makes sense.
Step 3, compute the gross profit earned to date, cumulative. This is the total expected profit, step 1, multiplied by the percentage complete, step 2. So $1,000 by 50% earned $500. That's the total profit earned across the project up to this point.
Step 3, $500 cumulative profit earned by end of year 1.
Step 4, compute gross profit earned for the current year. This is the cumulative profit earned to date, end of current year, step 3, minus the cumulative profit earned recognized in prior years. Since this is year 1, prior year profit is $0. So $500, cumulative year 1, $0, $500 profit recognized in year 1. Okay, $500 profit for year 1, that seems logical. Now, what happens in later years, especially if the estimated costs change? Say in year 2, costs incurred are another $900, total $2,400, but now they estimate total costs will be $4,000 instead of $3,000.
Great question. Cost estimates often change. Let's recalculate for year 2. Step 1, compute total expected gross profit. Contract price, $4,000, minus new estimated total costs, $4,000, $0 expected gross profit now.
Uh-oh, 0 expected profit.
Step 2, percentage of completion. Cost to date, $2,400 divided by new. Total estimated costs, $4,000,
Nope.
60%.
60% complete.
Step 3, cumulative gross profit earned to date. Total expected profit, $0 times percentage complete, 60%.
So cumulative profit earned by end of year 2 is 0.
Right. Step 4, gross profit for current year, year 2. Cumulative profit end of year 2 minus cumulative profit recognized at end of year 1, $500. So $0, $500, 5 scale of 500. The company has to recognize a $500 loss in year 2 to bring the total recognized profit down to 0.
Wow. Okay, so the change in estimate completely wiped out the profit and caused a loss in year 2. What if it gets even worse? Say in year 3, costs incurred are another $1,800, total $4,200, and now total costs are estimated at $4,200.
Now we hit the loss rule. This is a huge insight for you, the listener. Step 1, total expected gross profit. Contract price, $4,000, minus new estimated total costs, $4,200. The entire contract is now expected to lose money.
A $200 total loss expected.
Because the entire contract is expected to result in a loss, accounting principles require you to recognize that entire expected loss immediately. Forget the percentage complete for calculating profit. The cumulative profit instantly becomes negative $200. Step 3, cumulative profit earned to date is now negative $200.
Just jump straight to the total expected loss.
Exactly. It's a conservative principle. So step 4, profit for year 3, cumulative profit end of year 3, minus $200, minus $200 end of year 2, $0 free. Immediate recognition of the full anticipated loss. What if in year 4 costs are another $100, total $4,300, and total estimated cost is now $4,300? Same logic. Step 1, total expected loss is now $4,000. $4,300 equals $300. Step 3, cumulative profit loss instantly becomes $300. Step 4, profit loss for year 4, cumulative end of year 4, minus the $300, minus $200, negative $300. Additional $100 loss is recognized in year 4.
Got it. The key takeaway is that you recognize profit proportionally as you go, unless the whole project looks like a loss. Then you book that entire estimated loss right away. Very conservative. How does this look on the balance sheet throughout the project? You mentioned CIP and billings.
Right. 2 key accounts track the project status on the balance sheet: construction in progress, CIP. This is usually an inventory type account. It accumulates all the costs incurred on the project, plus the cumulative gross profit recognized to date, or minus the cumulative loss recognized. Progress billings. This is a contra inventory account. It accumulates the total amounts billed to the customer over the life of the project.
And they're netted.
Yes, for balance sheet presentation, these 2 accounts are netted against each other for each project. If CIP, costs plus recognized profit, is greater than progress billings, the net amount is typically shown as a current asset. It represents costs and profits incurred but not yet billed. If progress billings are greater than CIP, the net amount is usually a current liability. It represents amounts billed in excess of costs incurred and profit recognized, like getting paid ahead of the work.
Okay. Any specific accounting quirks or critical points, maybe some gotchas with this over time method we should highlight?
Well, the journal entries for recording costs, debit CIP, credit cash payables, and billings, debit accounts receivable, credit progress billings, are fairly standard. The key unique entry for the over time method is recording the gross profit earned each period. You debit CIP, increasing the asset, and credit an income statement account, often called something like realized gross profit on long-term contracts. Just to hammer it home, an estimated loss on the total contract is recognized immediately in the year it's discovered by recording a loss on the income statement and adjusting CIP.
Right, the immediate loss recognition.
And one final passkey alert, something that often trips people up. Be very careful with the terminology. Estimated total costs means costs from the very beginning, inception, all the way to the expected completion. Estimated cost to complete means only the costs remaining from the current point forward. To get the crucial estimated total cost figure needed for the percentage of completion calculation, you usually need to add the costs incurred to date to the estimated cost to complete. Don't mix them up.
Good tip. Cost to date plus cost to complete equals total estimated costs. Got it. B, recognizing revenue at a point in time. The completion method. Okay, so that's the overtime or percentage of completion method. If the company doesn't meet those criteria we discussed, customer doesn't control it as it's built, or there is an alternative use, or no enforceable right to payment for progress, then what? They have to use the at a point in time method, right? What does that mean in practice?
Exactly. If the criteria for overtime recognition are not met, then revenue and gross profit are recognized only when the contract is substantially completed. It's essentially saying, we haven't met the conditions to book revenue incrementally along the way, so we have to wait until the whole job is done and control is fully transferred. This method is often called the completed contract method.
Let's revisit that Tanner Co. example, but change the term slightly. Remember, they're building a unit. Now, let's say the deposit is refundable if Tanner fails to complete the unit. The remaining price is due only upon completion and acceptance. And if the customer defaults before completion, Tanner only gets to keep the deposit, not payment for work done so far. How do these different terms change the accounting method?
These changes are significant. With these terms, the performance obligation would likely be satisfied at a point in time upon completion. Here's why. First, does the customer control the unit as it's created? Probably not. The refundable deposit and payment only on completion suggests control doesn't transfer progressively. Second, does Tanner Co. have an enforceable right to payment for performance completed to date? No. The terms explicitly state they only get the deposit if the customer defaults before completion, not payment for the work performed.
So neither of the overtime criteria are met.
Correct. Therefore, Tanner Co. would have to use the at a point in time or completed contract method for this version of the contract. It really emphasizes again how critical those specific contractual terms are. Transfer of control and enforceable rights to payment really drive the timing.
That's a massive difference in reporting. So if a company is building something huge over several years, but maybe the contract says they don't get fully paid until it's 100% finished and accepted, they might not book any revenue along the way.
Potentially, yes. Under the completed contract method, that's how it works for profit recognition. They'd still track costs, of course.
How does the balance sheet look under this method compared to over time? Still CIP and billings.
Yes, you still use construction in progress, CIP, to accumulate the costs incurred, and progress billings to track amounts billed. And they are still netted for presentation. The crucial difference is that under the at a point in time completed contract method, the CIP account only accumulates costs incurred. It does not include any estimated gross profit until the contract is complete.
So CIP is purely a cost bucket until the very end.
Exactly. It just reflects the cost of the asset being built.
And what about the accounting entries? No interim profits hitting the income statement, I assume.
That's right. No estimated gross profit is recognized in the income statement during the construction period. Gross profit or loss is recognized only when the contract is completed. The total profit is simply the contract price minus the total costs actually incurred over the entire project.
What about losses, though? Does the immediate recognition rule still apply?
Yes, absolutely. That's consistent across both methods. If at any point during the contract, the company anticipates a loss on the entire contract, total estimated costs exceed total contract revenue, that loss must be recognized immediately in full in the year it's discovered. You don't wait until completion to recognize an expected loss.
Okay, so profits wait until the end, but losses are recognized right away. Still conservative on the loss side.
Always. And during the interim periods, the balance sheet simply shows the net balance of CIP costs only and progress billings as either a current asset or current liability, just like before, but without any profit component in CIP.
Let's look back at that multi-year example again, the $4,000 contract. How would the gross profit recognized each year look if they used the completed contract method instead of percentage of completion?
The difference is dramatic. Using the numbers from example 3 in our source material, year 1, $0 profit recognized, contract not complete. Year 2, $0 profit recognized, contract not complete, even though estimates changed. Year 3, mastered a $200 loss recognized. Why? Because in year 3, the total estimated cost, $4,200, exceeded the contract price, $4,000, indicating an overall loss of $200. That loss is recognized immediately. Year 4, completion. An additional added $100 loss is recognized. The total cost ended up being $4,300, making the total loss $300. Since $200 is recognized in year 3, the remaining $100 loss is recognized upon completion in year 4.
So zero profit in the early years, then the full hit of the loss as soon as it's anticipated, and any final adjustment at completion.
Exactly. This stark contrast clearly demonstrates how these accounting choices, driven by contract terms, can dramatically alter a company's reported performance year to year, even for the exact same construction project. For you, the listener, understanding this difference is crucial. It explains why one construction company's earnings might look smooth and steady, while another's might be zero for years and then show a huge profit or loss in the final year. It's all about when the criteria for revenue recognition are met.
That's a really powerful illustration. Same project, potentially very different financial story depending on the contract and the accounting method applied. By fee. Other advanced applications. Nuances and tricky scenarios. Okay, so we've built our foundation with the 5 steps and really explored the 2 approaches for long-term construction contracts. That's huge. But our source material has a whole section titled Other Applications. This sounds like where, the real accounting detective work comes in, dealing with all sorts of specific, sometimes tricky situations.
Absolutely. These are the situations that add layers of complexity beyond the basic framework or a standard construction project. They often require very careful judgment, really digging into the substance of the transaction to ensure revenue is recognized accurately. These often hinge on subtle distinctions in control, risk, contractual terms. It's where things get really nuanced.
Okay.
Incremental costs of obtaining a contract.
First up, incremental costs of obtaining a contract. What exactly are these, and when does a company get to capitalize them, treat them as an asset versus just expensing them right away?
Good question. Incremental costs are those costs incurred that the entity would not have incurred if the contract had not been obtained. Think costs that are directly tied to winning that specific deal.
Like sales commissions.
Exactly. Sales commissions paid only upon signing the contract are a classic example. Certain specific legal fees for drafting that particular contract might also qualify. These costs are capitalized, recognized as an asset on the balance sheet if the entity expects to recover them, usually through the revenue generated by the contract. This asset is then amortized or expensed over the life of the contract or the related goods services.
And what gets expensed immediately?
Costs that would have been incurred regardless of whether the contract was obtained are expensed as incurred. Think general marketing costs, the cost of preparing a proposal that wasn't specifically requested or wasn't successful, or maybe travel costs for a general sales pitch before a specific contract was likely.
Okay, let's use example 4 from the source. A software developer spends $42,000 trying to win a contract. This includes $10,000 in legal fees for the contract itself, $20,000 in travel costs to deliver the proposal and discuss it, and $12,000 in sales commissions payable only if they win the contract. Which of these get capitalized, assuming they expect to recover the costs?
Okay, let's break it down. The travel costs, $20,000, were likely incurred to make the pitch, costs that might have been incurred even if they didn't ultimately win or part of general business development. These would typically be expensed as incurred. The legal fees, $10,000 specifically for drafting this contract, are incremental. They wouldn't have been spent without this specific contract pursuit. So, capitalize. The sales commissions, $12,000, are payable only because the contract was obtained. Clearly incremental, so capitalize. Therefore, the company would capitalize $10,000 plus $12,000 equals $22,000 as an asset, often called contract costs or similar, and expense the $20,000 travel costs.
Got it. It really hinges on that, would this cost exist without this specific contract?
Yeah.
Question. Shows that not all money spent chasing a deal gets the same accounting treatment. B, cost to fulfill a contract. All right, what about costs incurred after the contract is won, specifically the costs needed to actually fulfill the promises in the contract? Is there a similar capitalization rule for those?
Yes, there is, but it applies to costs that aren't already covered by other accounting standards, like inventory, ASC 330, or property, plant, and equipment, ASC 360. For costs to fulfill a contract that fall outside those other standards, they are recognized as an asset if all 3 of the following criteria are met. 1, they relate directly to a contract or a specific anticipated contract, for example, direct labor, direct materials, allocated overhead directly related to fulfilling the contract. 2, They generate or enhance the entity's resources that will be used in satisfying performance obligations in the future. 3. They are expected to be recovered.
Okay. Generate or enhance resources. What kind of costs would not meet that and get expensed instead?
Costs expensed as incurred typically include general and administrative costs, unless explicitly chargeable to the customer under the contract, selling expenses, wasted materials or labor that weren't part of the plan, and costs related to performance obligations that have already been satisfied.
Let's use example 5. Same software developer, now fulfilling the contract. They buy an $8,000 workstation specifically for the technical support team dedicated to this new customer. They also assign an existing employee paid $30,000 annually who will spend 10% of their time supporting this customer, which cost is an asset, which is an expense.
Okay. The $8,000 workstation. That's a tangible resource. Buying it generates or enhances the developer's resources specifically used to fulfill this contract, and likely future ones. Assuming it's expected to be recovered, that $8,000 would be capitalized, likely as property, plant, and equipment under ASC 360, and depreciated.
Makes sense. It's a new physical asset. What about the employee's salary?
The employee cost, $30,000 annual salary, or the $3,000 portion related to this contract, would generally be treated as a payroll expense as incurred. Why? Because assigning an existing employee doesn't typically generate or enhance the developer's resources beyond what they already had. The employee. It's deploying an existing resource. It relates to the contract, yes, but doesn't meet that second criterion for capitalization under the fulfillment cost guidance. It would just be part of the period's operating expenses.
That's a subtle but important distinction, generating new resources versus just deploying existing ones. See, contract modifications. Life isn't static, and neither are contracts. What happens when a contract changes midstream? A change in scope, a change in price? Does that throw a wrench in all the revenue recognition we figure out so far?
It can, yes. Contract modifications are changes in the scope or price, or both, of a contract, approved by both parties. The accounting treatment depends on the nature of the modification. Sometimes, a modification is treated essentially as a new, separate contract. This happens if the modification adds distinct goods or services, meaning the customer can benefit from them on their own or with other readily available resources, and the price increase reflects the standalone selling price of those additional goods or services.
Like adding a completely separate service package onto an existing software license at its normal price.
Exactly. In that case, you account for the original contract as is and the modification as a brand new contract following the 5 steps. However, if those conditions aren't met, maybe the added services aren't distinct, or the pricing isn't at standalone value, then the modification is treated as part of the existing contract. This usually involves adjusting the revenue recognized for the remaining performance obligations, often on a prospective basis, a cumulative catch-up adjustment. It can get complex, but it reflects how businesses adapt to changing needs while keeping the accounting accurate.
So sometimes it's a new deal, sometimes it's just tweaking the old one. Depends on distinctness and pricing.
That's the core idea, yes. D principal versus agent.
Okay, this next one sounds potentially significant. Principal versus agent. You mentioned this earlier. When is a company considered the star of the show, the principal, versus just the manager or facilitator, the agent? This must massively impact reported revenue figures.
It absolutely does, and it's a crucial distinction for understanding a company's business model and true scale. The key determinant is control. A principal is a company that controls the specified good or service before it is transferred to the customer. The principal satisfies the performance obligation itself. Because they control the good service, they recognize the gross amount of consideration, the full selling price paid by the end customer, as revenue.
So they own it or are primarily responsible before it gets to the customer.
Right. An agent, on the other hand, does not control the good or service before transfer. Their role is to arrange for another party, the principal, to provide the good or service. The agent's performance obligation is just the arranging service. As a result, the agent recognizes revenue only for the fee or commission they earn for arranging the transaction, the net amount they get to keep.
Big difference between booking the wholesale price versus just the commission. What are the signs that a company is acting as an agent, not controlling the good?
The guidance provides several indicators that suggest an entity is an agent, meaning they do not control the good or service. 1. Another party, the principal, is primarily responsible for fulfilling the contract. 2. The entity does not have inventory risk before or after the customer order, during shipping, or on return. Basically, they aren't stuck holding unwanted goods. 3. The entity does not have discretion in establishing the price for the other party's goods or services. The principal sets the price.
Okay, those indicators focus on responsibility, risk, and pricing power. Let's use example 6. Anderson Co. contracts with Tanner Co. to provide a custom excavator for $385,000. Anderson then contracts with a separate manufacturer to produce it, paying the manufacturer $350,000. Critically, Anderson is responsible for ensuring the excavator meets Tanner specifications and for correcting any errors after delivery. Who's the principal here, Anderson or the manufacturer?
In this case, Anderson Co. is acting as the principal. Let's look at the indicators. 1. Who is primarily responsible for fulfilling the promise to Tanner? Anderson is, because they are responsible for meeting the specifications. 2. Does Anderson have inventory risk? Yes. They are responsible for correcting errors after delivery, which implies risk related to the product's quality and acceptance. 3. Does Anderson have discretion in establishing the price? Yes, they set the $385,000 price to Tanner, distinct from the $350,000 they pay the manufacturer.
So Anderson controls the promise to Tanner even though they don't physically build the excavator.
Exactly. They control the overall service of providing a conforming excavator. Therefore, Anderson recognizes the gross revenue of $385,000, and the $350,000 paid to the manufacturer is recorded as cost of goods sold. If Anderson were merely an agent, they might only recognize the $35,000 difference as revenue. Understanding this is crucial for interpreting a company's top-line revenue number.
Definitely. Seeing $385K revenue versus $35K revenue tells very different stories about the business. E. Repurchase agreements. All right, next up, repurchase agreements. This sounds like someone selling something but then having a way to buy it back. Feels a bit, I don't know, counterintuitive for a sale. Why would companies do this, and how does it mess with standard revenue recognition?
You're right, it seems odd, but companies use these for various reasons, maybe as a form of financing, or to manage inventory, or to provide guarantees to customers. A repurchase agreement involves an entity selling an asset, but also having either an obligation or a right to repurchase that asset later. The accounting treatment hinges entirely on who has the obligation or right, and the relationship between the repurchase price and the original selling price.
Okay, let's break it down. What if the selling entity has the obligation, a forward contract, or the right, a call option, to repurchase the asset?
If the entity has the obligation, forward, or the right call option, to repurchase, 1. If the repurchase price is less than the original selling price, it's generally accounted for as a lease under lease accounting standards, ASC 842. The seller is essentially leasing the asset back. 2. If the repurchase price is equal to or more than the original selling price, it's accounted for as a financing arrangement.
Financing, so not a sale at all.
Correct. No sale is recognized. The entity keeps the asset on its books. The cash received from the customer is recorded as a financial liability. The difference between the cash received, or original selling price, and the cash to be paid back, repurchase price, is recognized as interest expense over the term of the arrangement. It's essentially a collateralized loan.
Wow. So what looks like a sale could actually be booked as debt. Let's use example 7. Anderson sells an excavator to Tanner for $350,000 cash. However, Anderson also has a call option allowing them to repurchase the excavator in 1 year for $385,000. What's the accounting for Anderson here? Sale or financing?
This is a classic financing arrangement. Why? Because Anderson has the right call option to repurchase, and the repurchase price, $385,000, is greater than the original selling price, $350,000. So on January 1st, Anderson records debit cash, $350,000, credit financial liability, $350,000. No revenue, no removal of the excavator asset from their books.
Okay, asset stays, cash comes in, liability goes up. What happens during the year?
And during the year, Anderson recognizes interest expense on the liability. The total interest is the difference between the repurchase price and the original price. $385K, $350K equals $35K. This $35K is accrued as interest expense over the year, so you'd see entries like debit interest expense, credit financial liability totaling $35K over the year.
And what if, at December 31st, Anderson lets the call option lapse? They decide not to repurchase.
If the option lapses, then control effectively transfers to Tanner. At that point, Anderson would derecognize the excavator asset, remove the financial liability, which would now be $385K after accruing interest, and finally recognize revenue of $385,000. The sale happens when the repurchase right expires.
Fascinating. The accounting follows the economic substance. It wasn't truly a sale until Anderson gave up the right to get it back. Now, what about the other side? A put option, where the customer, Tanner, has the right to require the seller, Anderson, to buy the asset back.
Put options add another layer of complexity, as you also need to consider the customer's economic incentive to exercise the option. Scenario 1. Repurchase price is less than the original selling price. If the customer has a significant economic incentive to exercise the put option, e.g. the repurchase price is expected to be much higher than the asset's market value at the time of repurchase, then it's accounted for as a lease. If the customer does not have a significant economic incentive, it's treated as a sale with a right of return.
Okay, incentive matters there. What if the repurchase price is equal to or greater than the original selling price?
Scenario 2. Repurchase price is equal to or greater than the original selling price. If the repurchase price is more than the asset's expected market value at the time of repurchase, it's treated as a financing arrangement, similar to the call option case. If the repurchase price is less than or equal to the expected market value A and D, the customer has no significant economic incentive to exercise, it's treated as a sale with a right of return.
Wow, okay, lots of conditions there. Let's try example 8. Anderson sells the excavator to Tanner for $350,000, but Tanner has a put option. Anderson is obligated to repurchase it at Tanner's request in 1 year for $315,000. Critically, the excavator's market value at that time is expected to be only $275,000. How is this one accounted for?
Okay, let's analyze this step by step. 1. The repurchase price, $315,000, is less than the original selling price, $350,000. So we're in scenario 1. 2. Does Tanner have a significant economic incentive to exercise the put option? Yes, definitely. They can force Anderson to buy it back for $315,000 when his market value is only expected to be $275,000. That's a guaranteed $40,000 gain for Tanner compared to selling it on the open market.
So, repurchase price is less than original. Andy Tanner has a strong incentive to exercise.
Correct. Therefore, according to the rules, this transaction is accounted for by Anderson as a lease. No sale is recognized up front. These repurchase scenarios really drive home how accountants must look beyond the surface label of sale and analyze the rights, obligations, pricing, and economic incentives embedded in the contract to determine the true substance and the correct revenue recognition timing. It's about who truly bears the risks and rewards of ownership.
Absolutely. What looks like a sale might be a lease, financing, or a sale with a return right, all with different accounting. F. Bill and hold arrangements. Next challenge. Bill and hold arrangements. This is where a company bills a customer for a product, but hangs on to it for them. It sounds like a potential recipe for recognizing revenue too early if you're not careful.
You're right to be cautious. These have historically been areas of abuse. The core principle remains. Revenue cannot be recognized until a customer obtains control of the product. Usually, control transfers upon shipment or delivery. However, in a bill and hold arrangement, the customer might gain control before physical delivery, but only if all 4 of the following strict criteria are met.
All 4. Okay, what are they?
1. The reason for the bill and hold arrangement must be substantive. Usually this means the customer requested it. For example, the customer lacks storage space currently. It can't just be the seller's idea to meet sales targets. 2. The product must be separately identified as belonging specifically to that customer. It can't be fungible inventory the seller could use elsewhere. 3. The product must be currently ready for physical transfer to the customer. It can't still be in production or require further work. 4. The entity, the seller, cannot have the ability to use the product or direct it to another customer. The seller is essentially just holding it for the customer.
Those are tight conditions. Substantive reason, identified, ready, and seller can't touch it. Let's use example 9. Anderson sells an excavator and some unique spare parts to Tanner. Tanner pays for both, but requests Anderson hold on to the spare parts for 3 years because Tanner has no storage space. The parts are separately identified in Anderson's warehouse, they are ready for transfer, and Anderson contractually cannot use them or sell them to anyone else. What are the performance obligations and when is revenue recognized?
Okay, analyzing this. First, identify the performance obligations. There are likely 3 here. 1, the excavator itself. 2, the spare parts. 3, the custodial or storage services for the parts over 3 years.
3 distinct promises.
Right. Now, when is revenue recognized? For the excavator, revenue is recognized when control transfers, likely when Tanner takes physical possession on July 1st. For the spare parts, even though Anderson still holds them, all 4 bill and hold criteria appear to be met here. Substantive customer request, identified, ready, seller can't use. Therefore, Tanner likely obtains control of the parts on July 1st as well, and Anderson recognizes the revenue allocated to the parts then. For the custodial services, this is a service provided over 3 years. So the revenue allocated to this obligation is recognized over that 3-year period, likely on a freight line basis, as the service is performed.
Interesting. So revenue for the machine and the parts hits all at once when the machine ships because the parts meet the bill and hold test,
Hmm.
but the revenue for storing those parts is spread out over 3 years.
Exactly. It shows how different parts of a single contract, different performance obligations, can have different revenue recognition timings based on when control transfers for each specific promise. G consignment.
All right, let's talk about consignment arrangements. We see this with things like art galleries selling an artist's work or maybe some car dealerships. The dealer has the product but doesn't technically own it initially. How does that work for revenue recognition?
Consignment is fundamentally different from a standard sale to a distributor because, in a consignment arrangement, the entity sending the goods, the consignor, retains control of the product even while it's in the hands of the dealer or distributor, the consignee. Because the consignor retains control, they do not recognize revenue when they ship the goods to the consignee. Revenue is recognized by the consignor only when one of two things happens. Either the consignee sells the product to an end customer, or the consignee obtains control of the product themselves, for example, after a specified period expires.
So delivery to the dealer isn't the trigger for revenue. What are the signs that an arrangement is actually a consignment, not a sale?
The key indicators that suggest an entity, the consignor, has retained control, and it's a consignment arrangement include 1. The entity, consignor, controls the product until a specified event occurs, like sale to end customer or a specified period expires. 2. The dealer, consignor, does not have an unconditional obligation to pay for the product. They typically only pay the consignor after selling it. 3. The entity, consignor, can require the return of the product or can transfer the product to another party, like a different dealer.
Okay, control, no obligation to pay yet, and ability to recall. Let's look at example 10. FMC, a car manufacturer, delivers cars to a dealer. Legal title passes from FMC to the dealer only when the dealer sells the car to a customer. The dealer pays FMC only when that title passes, and FMC has the right to demand the cars be returned or transferred to another dealer at any time, sale or consignment.
This is a classic consignment arrangement. Let's check the indicators. 1. Does FMC control the product until sale? Yes, they can require its return or transfer it elsewhere. 2. Does the dealer have an unconditional obligation to pay upon delivery? No. They only pay when title passes upon sale to the end customer.
Fits the criteria perfectly.
Right. So the crucial implication for FMC is that revenue is not recognized when the cars are delivered to the dealer's lot. Revenue is only recognized when the dealer actually sells a car to a final customer. Understanding this is vital for analyzing industries like auto manufacturing or publishing, where consignment is common. It affects inventory levels, risk assessment, and of course, the timing of revenue.
Each warranties.
Warranties. Everyone deals with these when buying electronics, cars, appliances. From a revenue recognition standpoint, are they always just considered part of the product cost, or can they sometimes be treated as a separate service you're selling? That's a great question. And the accounting hinges on whether the warranty provides something more than just assurance that the product complies with agreed-upon specifications. The key determining factor is often whether the customer has the option to purchase the warranty separately.
So if I can buy an extended warranty plan.
Exactly. If the warranty or a portion of it can be purchased separately, or if it provides a service beyond basic assurance, it's likely a distinct service and therefore a separate performance obligation. In that case, a portion of the total transaction price must be allocated to the warranty obligation, and that allocated revenue is recognized over the warranty period, not up front when the product is sold.
And if it's just the standard, legally required, or basic, it won't break warranty that you can't buy separately?
If the warranty cannot be purchased separately and simply provides assurance that the product works as intended, it's generally not considered a separate performance obligation. The costs associated with fulfilling such assurance-type warranties are typically estimated and accrued as a liability, a warranty reserve, when the product revenue is recognized, following guidance on contingencies rather than revenue recognition.
Are there other factors besides separate purchase option?
Yes, the guidance suggests considering. 1. Is the warranty required by law? If yes, it's less likely to be a separate performance obligation. 2. What's the length of the coverage period? Longer periods make it more likely there's a service component beyond basic assurance. 3. Does the warranty require the entity to perform specific tasks needed for assurance, like routine maintenance? If so, it's less likely to be a separate performance obligation. more likely part of assuring quality.
So the takeaway is that extended warranties or service contracts sold alongside products often result in deferring some of the revenue over the life of that warranty service.
Precisely. It impacts how companies like electronics retailers or car manufacturers structure their offerings and how those bundled deals show up in their financials over time. Buy refund liabilities and the right to return.
Okay, last one in this tricky section. What about when customers return things? Especially now with often very generous return policies. That must affect the revenue recognized, right? You can't just book the full sale if you expect a chunk of it to come back.
Absolutely not. Companies need to account for expected returns. This is where the concept of a refund liability comes in. An entity must recognize a refund liability if it receives consideration from a customer, but anticipates having to refund some or all of that consideration. This liability represents the amount the entity does not expect to be ultimately entitled to keep.
So it's like setting aside the money you think you'll have to give back?
Exactly. When selling products with a right of return, the accounting involves a few steps. 1. Recognize revenue only for the amount of consideration the entity expects to be entitled to receive, i.e. sales price minus the expected refunds. 2. Recognize a refund liability for the amount expected to be refunded. 3. Recognize an asset and corresponding adjustment to cost of sales for the right to recover the products from customers upon settling the refund liability, basically accounting for the value of the goods expected back.
Okay, let's try a simple journal entry from the source. Say a company makes $50,000 in cash sales during a period, but based on past experience, they estimate that products representing 10% of sales will be returned. How would the initial sale be recorded?
Okay, so they receive $50,000 cash. They expect 10%, $5,000 to be refunded. The entry would be debit cash, $50,000. Credit refund liability, $5,000. The amount expected to be returned. Credit sales revenue, $45,000. The net amount expected to be kept. So only $45,000 hits the revenue line immediately, even though $50,000 cash came in.
Got it. Sets aside the expected refund. Then what happens when a customer actually returns something, say for $3,000 cash back?
When the return occurs, the company settles part of the liability. The entry would be debit refund liability, $3,000, reducing the liability.
Okay.
Credit cash, $3,000, paying the customer back. There would also be a related entry to put the returned inventory back on the books by debiting the return asset account and crediting cost of sales.
Okay, so the initial estimate directly reduces the revenue recognized upfront. This seems crucial for understanding companies with very liberal return policies. They should be booking less revenue initially to account for that.
Exactly. It provides a much more realistic picture of the net sales the company truly expects to realize from its transactions, factoring in customer satisfaction policies from day one. V. Operational integrity.
Yeah.
Reconciling sales data for accuracy.
So we've journeyed through all these complex rules for when and how much revenue to recognize, covering everything from basic sales to construction, consignments, returns. It's intricate stuff. But how do companies actually keep track of all this day to day? Especially companies with huge volumes of sales transactions. There must be robust systems in place.
Absolutely. Operational integrity is paramount here. You can have perfect understanding of the rules, but if your systems for tracking sales aren't accurate, your financial statements won't be either. In high-volume environments, companies rely heavily on sales subledgers or subsidiary ledgers.
Subledgers, like a detailed list behind the main account.
Precisely. The general ledger might just have one main sales revenue control account showing the total. The sales subledger contains the detailed information for each individual sales transaction date, customer, specific product or service, transaction amount, whether it was cash or credit, maybe salesperson or region. This level of granularity is incredibly important, not just for accounting accuracy, but also for management. It provides insights for analyzing sales trends, customer behavior, product performance, things you can't see from just the total sales number.
Makes sense. You need the detail for analysis. And how does that detailed subledger connect back to the main financial records, the general ledger that feeds the financial statements? They have to match up, I assume.
They absolutely must match. This brings us to the crucial process of reconciliation to the general ledger. At the end of each reporting period, at least monthly, the total balance calculated from all the individual accounts or transactions in the sales subledger must equal the ending balance shown in the sales revenue control account in the general ledger.
Why is this reconciliation so critical?
Because the reliability and integrity of a company's reported sales data are fundamental. If the detailed records don't support the summary number reported to investors, regulators, and management, it suggests errors or potentially even fraud. Discrepancies undermine the trustworthiness of the entire financial reporting process.
Okay, so they have to match. What if they don't? What's the actual process for finding and fixing the differences? It sounds potentially painstaking.
It can be, especially if controls are weak, but it's essential. The reconciliation process typically involves 1. Comparing the total from the sales subledger with the general ledger control account balance. 2. If there's a difference, investigating begins. This involves reviewing and comparing specific transactions posted in both ledgers during the period. 3. Identifying the specific items causing the discrepancy. Was it an error in the subledger, an incorrect entry in the general ledger, a timing difference? 4. Making the necessary adjustments. This could involve correcting entries in the subledger or posting adjusting journal entries to the general ledger. 5. The process isn't complete until the adjusted balances in both the subledger and the general ledger are equal.
What are some common reasons why these differences might pop up, and how are they typically fixed? Are there recurring culprits accountants look for?
Yes, there are several common reasons for discrepancies. Incorrect entries directly in the GL. Someone might post a manual journal entry to the sales control account incorrectly. This requires an adjusting journal entry in the GL to fix it. Month-end adjustments, not in subledger. Sometimes adjustments, like for complex revenue recognition estimates, are posted only in the GL at month-end and aren't automatically reflected in the detailed subledger. The subledger might need manual updating, or the reconciliation needs to account for these topside adjustments. Automatic posting errors. Maybe transactions from a certain system feed are being automatically miscoded, posting to miscellaneous revenue instead of the main sales account. This requires fixing the underlying posting rules and making adjusting entries in the GL. Discounts and allowances. Sales discounts or returns might be recorded as direct offsets within the sales detail in the subledger, but they might hit separate contra-revenue accounts, like sales returns and allowances, in the general ledger. The reconciliation needs to ensure it's comparing total net sales, including these related accounts, often meaning no actual adjustment is needed, just a broader comparison.
So it's a mix of data entry errors, system glitches, timing issues, and sometimes just differences in how detail versus summary accounts are structured.
Exactly. And this reconciliation process, this is really where the rubber meets the road for operational finance and accounting teams. It highlights that even in our highly automated digital age, meticulous human oversight, strong internal controls, and rigorous reconciliation procedures are absolutely essential. They ensure companies' reported sales numbers, often the most scrutinized figure, are accurate, reliable, and truly trustworthy. It's the silent hero of financial integrity, if you will.
The silent hero, I like that. Ensures the foundation is solid. Outro. Wow, what a journey that was. Seriously, from the fundamental 5 steps that, every business should be using to navigating the real intricacies of things like long-term construction contracts, figuring out principal versus agent, deciphering those repurchase agreements, and even understanding how something as common as a warranty gets accounted for. We've really seen how dynamic and, frankly, how nuanced revenue recognition truly is.
Indeed. It fundamentally underscores that revenue isn't just some simple number that pops out. It's a carefully determined figure. It reflects a company's actual fulfillment of its promises to customers, the transfer of control of goods or services based on a globally recognized framework. And understanding these advanced topics significantly shapes how you, as an observer or investor, can understand a business's true performance, its operational efficiency, maybe even its underlying risk profile.
You've definitely now got a shortcut to being truly well-informed on this vital topic. I mean, the next time you look at a company's sales figures, whether it's in an earnings report or just a news headline, you'll know there's a whole world of meticulous accounting, estimates, judgments, and crucial decisions happening behind that single number. It's not just magic.
It's definitely not magic. And maybe it raises an important question for you to consider going forward. How might understanding these advanced topics change your perspective when you look at different business models? For example, think about comparing, say, a software as a service company with recurring revenue recognized over time versus a traditional retailer recognizing revenue at the point of sale. Or comparing a company building massive infrastructure projects over decades using percentage of completion versus one selling consumer goods with high return rates. Their financial stories look very different because of these underlying accounting principles.
That's a great point. How does the way they recognize revenue shape our perception of their stability, their growth, their profitability? Think about that next time you see a company announce its quarterly revenue. There's always more to learn, of course, and we're really just scratching the surface of this fascinating world of accounting standards. But until next time, keep digging, keep asking those questions, and stay well informed.